Think you'll inherit your parents' house tax-free? Think again. The Canada Revenue Agency has a rule that quietly turns a family home into a massive tax bill, and most Canadians don't find out until it's too late. Today, we're breaking down the CRA's hidden inheritance tax trap. I'll show you how it works, who it hits the hardest, and what you can do right now to avoid a nasty surprise when a loved one passes away. Number 1. Canada doesn't technically have an inheritance tax. That sounds good, but here's the catch. When someone dies, the CRA treats all of their assets, including real estate, as if they sold them the day before death. This is called a deemed disposition. If the home isn't fully covered by the principal residence exemption, any gain since it was bought is taxed as a capital gain, and capital gains are taxed at 50% of the profit. So if your parents bought a cottage for $200,000 that's now worth $800,000, the estate could be on the hook for tax on $300,000 of gain. Number 2. The principal residence exemption isn't a magic shield. It only covers one property per family unit, and only for the years it was actually designated. If your parents own a house and a cottage, or if they rented the property out for a few years, the exemption can shrink fast. Even changes, like adding a basement apartment for rental income, can complicate things. Many families assume it's the family home, so no tax, and they're wrong. Number 3, even if capital gains aren't huge, there are other costs. Every province charges probate fees to validate the will. In Ontario, it's roughly 1.5% of the estate's value above $50,000. On a $1 million Toronto home, that's about $14,250 just to transfer the title. British Columbia, Nova Scotia, and other provinces have their own fee schedules. These aren't technically taxes, but they drain the estate before you even touch the property. Number 4. Smart planning can cut the damage. Families can name a spouse as joint owner to defer the tax until the second death. They can use estate freezes or transfer property to a trust to lock in today's value. Even something as simple as keeping good records of renovation costs can increase the property's adjusted cost base and reduce the taxable gain. The key is to act while the owner is still alive. After death, the CRA's calculation is final. Number 5. Talk to a tax professional before making any move. Rules around trusts, joint ownership, and principal residence elections are tricky, and one wrong step can trigger more tax than you save. A 30-minute consultation today can prevent a 6-figure headache later. The bottom line: Canada doesn't call it an inheritance tax, but the CRA will still take a cut of your family home if you don't plan ahead. Don't wait until it's too late. Start the conversation now. If you found this breakdown helpful, hit subscribe and share this video with a friend who thinks their inheritance is safe. Staying informed is the first step to keeping more of what's yours.